Hey everybody, this is Jose Blasco. We are about to get started in just a moment. Let's have a quick sound check as we always do. Quick message on the chat box would be very helpful so I know that you hear me, which that should be the case. But again, always good to have that confirmation. So please go ahead. Sound check, everybody. Please let me know that all is good with a quick message on the chat box. Thank you so much. Okay, looks good. How are you, Mario? Good to see you. Very nice, everyone. I will turn on the video stream so I can say hi here from my little corner, as always. And just getting all set up here on my end so we can start. Here we go. It's the top of the hour, so it's time to begin. Here we go. Welcome to the session, everybody. I am highlighting the disclaimer on the upper left side of the screen. Please read it carefully. This is important information. My name is Jose Blasco. This is Options with Options. Today is September 1st, 2021. Happy September, everybody. First day of the month. And we are getting together to trade options, as the session suggests, isn't it? And we're going to be looking at the markets from different angles, looking for the most intelligent opportunities given the current market conditions. So talking about market conditions, we'll start looking at market environment so we understand what's happening out there. From them, we'll do trade review. We have a couple of trades that are running, so we'll talk about those. Then we'll talk about the trade management of those trades, if anything needs to be done. And then from there, we'll move into identifying new trading opportunities. Okay. Joe, how are you, Joe? Good morning. Yes, yes, I can see the attendance, but we are streaming in simultaneously in multiple places at the same time. And apart from having someone, having the name of that person in the room, that doesn't tell me if they hear the sound or they don't. Okay, so that's why we always start with a sound check, if you wish. Siderman, how are you? Good to see you. Yeah, thanks for that, Siderman. Yeah, I'm really sorry. Last week we had to cancel the Thursday session, guys. Really, really sorry about that. But hey, I guess that we are human in the end, even though we use the UFO trading. So yeah, so we are not alien, we are human, and sometimes we're a little bit under the water. But yeah, thanks for that. You guys have been very nice to me with multiple messages, to check on me on how I was doing. It was nothing serious, but it was kind of like uncomfortable enough to not be able to run the session last week. Okay, so thank you for your concerns, guys. Back to normal, 100%, full energy, and eager to trade. Maka, how are you? Maka, it's very good to see you. Ahmed as well. I believe you may be back from those trips, isn't it, Maka? I hope everything went well, and you're ready to begin, trading in September and ready to kill it. Okay. Anyway, so let's begin. Everybody, market analysis. Okay, so this is the first part of the session. So the first thing that we can see here is the S&P 500 ETF. I am looking, as always, at the daily time frame on the left. We can see the climate, and what the climate is showing you is 8 out of 16. In other words, we are now in a hopeful condition. The market has been stretching for a little bit too long when it comes to the amount of time it's been in that market condition. But not only too long, a bit also too fast, because when you look at the max distance, so max distance suggests that 1.028 yards away from the mean, it's the time where the market tends to roll over after that. Okay, and the maximum level that we reached was 137. That was on that particular day. Okay, right there. So that we reach 137. Which exceeds what probability suggests, and therefore, not only this market has been too long in this condition, it's also traveled with too much speed, and therefore we are hitting, from both angles, max distance and count, we are hitting an alert, which is kind of like, this market is more likely going to turn around than not. Okay, so again, this doesn't mean that next thing you know, we're gonna short everything available out there. Last week I was looking for an opportunity to short, which I was able to plan but not to execute during the session. Maybe some of you did execute it. If that was the case, as we all know by looking at the chart, the market kept going higher in the remaining part of the last week and beginning of this week as well. So obviously then that hedge would not help too much, but the other position in your portfolio will be doing well, which is the purpose for a hedge, okay? Now, if last week we had a little bit of a reason to look for hedging, this week it's even more, because when you look at the difference between the puts and the calls, you can see that now the difference is quite substantial, which together with what we just assessed with the auto climate, well, all those things together are telling us there is real risk for a correction in the market. And again, a correction doesn't mean the world is ending. A correction based on statistics means a couple of days going down, maybe 3, and from there turn around, come back up. Especially because when we look at the 55-minute time frame, we have those green UFOs right there. So it's not like the market has room to drop all the way to the infinite. If the market drops, it's likely going to react to those UFOs and continue its progression to the upside. And dropping that low may take 1, 2, maybe 3 days, and that's what basically we are concluding by looking at the auto climate, as we just said. Okay, so be ready for that, guys. There is a possibility for this to happen. And again, today I'll start the session looking for shorting opportunities, because we have 2 long trades in the account, right? With First Solar and Intel, and therefore I need to add a little bit of a hedge. Okay, so I will be planning on that right after we review the trades that we have. Looking at the VIX. Hey Maka, yes, very very nice to see that you are back, and indeed, Ahmed, well said. Welcome back, Maka. So looking at the VIX is currently trading at 16.22. Again, in the middle of nowhere. Green UFOs are 15, the red UFOs are 17.83. So we are in the middle of nowhere, and anything could happen, really. Okay, not a clear day where you would say, okay, today I'm just going to be selling premium. Today I'm just going to be doing double diagonals or double calendars. No, today basically the VIX is not providing anything specific for us to use as an information to decide if we want to be premium buyers or premium sellers. Okay, so we'll give priority to what I just said when I analyze the S&P, in the sense of that directional risk for the market to turn down and crash. Okay, cool. Okay, so trades that we have in the portfolio right now. Okay, so I'm going to bring the position panel here so we can take a look at First Solar and Intel. I will also bring TOS, where we can see those trades in the account more precisely. So we can see that First Solar is reporting a profit of $67.5 per contract, and we can see Intel that shows minus $2 of loss at this moment in time. Okay, so those are 2 long trades. With First Solar, we are running a bull call spread with October expiration. With Intel, we are running a call, okay, using also October expiration. But this is not how this trade started. Okay, so if I start with Intel, the way the trade started, and I'm just going to zoom in. So the way the trade started is that we went ahead and we took two bull put spreads made of selling the 50 put and buying the 47.5. We collected premium, and in exchange for that, we paid for the call. Last week, we closed that for a small profit that basically made this trade almost free. If I'm not mistaken, we ended up with $9 of net cost for the call. Okay, and therefore, if I look at this long call, which I have priced at $9, so the net profit of the trade, as you can see, is $39. Okay, and actually, to make it equal to TOS, I'm just going to use the midpoint. Okay, so $36. Okay, that would be the profit of the trade right now, if you account on the tweak that we did last week when we closed the 2 bull put spreads. Okay, if we didn't, we would be up by $50. Okay, that would be the net result of the trade. We did, so now we are up by $36 only, which is a little less, but at the same time, I'm happy we did it because we removed the risk of the trade, right? I mean, we didn't remove it fully. We still got $9 to lose on this trade. So if Intel crashes and goes all the way to 0, so we'll lose $9. Okay, that's the worst case. But again, overall, we are up by $36. So don't get confused when you look at TOS and it shows minus 1.5, because indeed, that call, given the fact that it was bought and we paid for it $49, that call is currently reporting $1.5 of loss by itself. But if you add the profits that we made with the puts, we are actually up by $36. Okay, so Intel doing okay. Let's go ahead and take a look at Intel so we can assess the chart and what's happening. So let me move here to the daily time frame. Sorry, we were using a 2-day chart exactly. So this is where we enter the trade, isn't it? We enter the trade with those UFOs coinciding with a speed bump, and this was the reason for us to enter the trade. So Intel is now moving. Our target, if you recall, is all the way here at 57.90. Let's call it 58. So there is a long way to go, and that's why we're using October expression to give ourselves time to get there. So we are in the right place, and now it's a matter of riding the move and not being in a rush, knowing that the most you can lose is $9. Let's ride the move. Let's be calm and ride it, and let's see how far it goes. Okay, so when Intel moves higher, I'm not gonna do it now to not to use basically silly time, but because it's too far from target. But when Intel moves and it's, let's say, about 55 plus, so then we look into reconverting that call into a bull call spread or other tweaks that could be possible. We'll assess that when the time is right. Right now we are just a bit too close to the tweaks that we did last week, and therefore doing something now doesn't really make sense. So we're just going to leave it the way it is for now and enjoy the ride with Intel. You guys, if you have any question, feel free to comment. Remember, we had a mini deal last week where we said that we're going to be just a bit more interactive. Okay, I'm not complaining about anything at all, don't get me wrong, but I think it's a good habit if we develop just a bit more interactivity with the chat box, guys, because that really helps me on my end. This is a little bit of a selfish request, if you don't mind, but at the same time it will also help you to be a bit more focused on the session and so on. Okay, so please give me a confirmation that you are with me on Intel, and if there is any question on Intel, this is your time, because I am moving to First Solar. Okay, but I'm happy to go back to Intel to take a look if you had any question that was unanswered. Clive, I see you are here with us as well. Nice to see you, my friend. Good. Okay, so let's continue. What else? First Solar. So with First Solar, we entered some time ago, and if you recall, that stock started moving very quickly in our favor. I remember being able to see on the P&L around 200 plus. Intel okay. I have a question. How can I set my tops similar to yours? Not a problem. Top has something called pages. Okay, so open page, save page. So the pages basically are my environment. Okay, and you should save your page as well. So what I can do, if you email me, I can send you my page. Okay, this is the page on top is similar to what you would call a workspace on TradeStation. And then you can just open my page, and your screen will be exactly the same as mine. Okay, unless you have different resolution and stuff, where then you may need to adjust manually the size of your windows and things like that. But basically, the colors, the settings, and so on will be exactly the same. Okay, so feel free to email me and request my page, and I will be happy to share my page with you guys. Clive, fine on Intel as well. Okay, great, perfect. So First Solar, I was saying that there was a moment in time where we saw about $200 plus per contract of profit. Currently, it's showing 58 right now as we speak. So, what does that mean? Well, it means that stock has been a little bit of challenging, especially when it comes to the human emotions. Okay, it went up, it went down, and it's been doing things. Also, when you look at the implied volatility of that stock, when we entered, volatility was quite low. Okay, and we benefited from that, but then it went even lower than when it was low. Okay, so volatility is 34% now, which is as low as what it was or lower than when we started. Okay. Thank you, Ahmed. Of course, my friend. How can you see the UFOs? Well, if you open my page, you will automatically see the UFOs. But if not, you just right click to add study. Okay. And then you find UFOs there on the top. Okay. And you just click on it, and the indicators will show on your charts. Okay. So they are under add study. Okay, that's where they are. Cool. And by the way, guys, later in the session, we'll have another mini conversation about top. And right now, I'm just trying to get into the trades, okay, just to use our time for what is supposed to be, what it's supposed to be. But definitely later, I want to ask you, how is it going, guys? A few of you are already utilizing top. And definitely, I would like to gather a little bit of your feedback. You had limited time to use it, of course, but still, I'd like to listen to you for a moment so you can share your initial experiences. That would be great. Okay, but we'll do that later if that's okay. Thank you, Clive. Thank you, of course, my friend. So anyway, so again with First Solar, remember I had an attempt to convert this trade into a directional butterfly. When we looked at it, it didn't work too well. And today, to be honest, we are more or less at the same level. So I don't think it's going to work too well. Our target is 102. Okay. I don't think it's going to work too well to do a conversion. I don't think it's going to be that helpful. But I think it's worth it to check again, because if you look at the trade price for the 115 call that we sold when we entered the trade, that call is now trading at half of its value, 42 cents. And why is that? Well, the reason why is because a little bit of time has passed, but most importantly, the fact that the implied volatility went down basically kind of killed a lot of the premium that was in this call. So because of that, we may have an opportunity to convert this trade into a directional butterfly and improve the performance of this trade versus what we have. Last time when we tried to do that, it was not really working because we were still with a higher level of implied volatility. So closing that call or doing anything with that call was not really being too helpful. So I want to revisit multiple possibilities with First Solar. And the way I'm going to do that is I'm just going to right click on the trade and open a risk graph. And from the risk graph, I'm just going to be working on this trade on see what type of tweaks can we implement, okay, if any. Okay. And one efficient way to also do that is to use the compare spread function, where now I'm gonna be able to copy the primary spread. Then I got my spread on the top, my spread on the bottom, and now I can work on that spread to try to make it better, okay? And try to find an advantage by doing a tweak, okay? Okay, so let's edit that spread. Okay, I'm gonna work on the orange one, okay, which is the one I want to tweak and see what happens. And the idea here, let me make some notes, what we explored last time was the following. So this trade is made of selling the 115 call and buying below the 92.5 call. Okay, this is what this trade is made of. It's a bull call spread. Okay, so how can we work on this trade in a different way? Well, another way to work on this trade is to potentially, there are different things that we can do, but one of the things that we can do is to go ahead and get rid of that 115 call. And that would provide a little bit of a profit in the account. Nothing too major, but we would take that. And then potentially we can go ahead and sell a couple of calls a bit higher. Okay, maybe we can use, again, we need to try to see what the right strike is going to be, but maybe we can do 117.5 and we would sell two of those. So it would be minus 2x, okay, minus 2x, okay. And as we do that, then we would turn around, okay, and then all the way on top at the same distance, okay, then we would buy a call on top, okay, because if I sell two calls, okay, and I'm long one call, so then I am net short one call, and that is not allowed in accounts such as IRA accounts or accounts with no margin. But on top of that, it also opens for a potential of risk which is unlimited to the upside. And remember, don't forget that even though First Solar has not really shined that much so far, First Solar belongs to a strong group and a strong sector when we pick the trade. So if the sector kicks in, which may happen 3-4 days from now, if the S&P corrects a bit and then starts pushing higher, maybe that sector will kick in. So then you may get to see First Solar fly to the upside. And if I was to be net short a call, meaning that if I was not to buy a call against those three calls below, so then my problem is that I may end up being hurt too fast on the two calls I'm short, right? So to offset that problem, I will want to buy a call far away to remove the mathematical risk of the trade, not to remove it, but to limit the mathematical risk of the trade, and also to add a little bit of delta if the stock was to move very fast. Okay. So anyway, that's a lot of words. So let's do it. Okay. So first thing I want to do is what happens, okay, if I close the 115 call. So in other words, if I buy the 115 call, not at the field price, but at the current mid price, right? So I buy the 92 and a half and I pay 580. I sold the 115 and I got paid 91. And now I sell the 115 again, okay, at the current price. So that is equivalent to simulating I close that call, right? So you guys with me on that? Is everybody with me that if I do that is like I close the call, I am simulating I close the call now. Now, if I close the call now, okay, as I said, then I want to add another option leg, okay, where what I will want to do here is I will want to sell two of a call which is the higher price, which I thought that the 117 and a half was available, is not. So I guess it's going to have to be the 120. Okay, so let's begin with that. Okay, I see the yeses. Okay, I see that all of you guys are following. I'm looking at the various chat boxes. You guys are with me. Perfect. Wonderful. So now, what I'm doing now is, I'm closing the 115 and then I'm selling two of the 120s. Okay, and again, we need to add one call above that, right? Because if not, I would be net short one call. But I'm going to do it in a moment because what I don't know is how much I get paid for the 120. Maybe I get paid nothing at all. So, and then it's not worth it. So how much I get paid for the 120? So it seems that the 120 would pay anywhere between 24 and 70. The midpoint is 47. That's the midpoint. So I may get 47 cents for the 20 call, which funnily enough, because of the potential slippage, it's actually more than what I will get for the 115. Okay, so that's going to be this is not a normal thing to see, and again, it's because if we look at the bid and the ask for the 120 call here below, let me highlight it so you guys are with me. So if you look at the bid and the ask, okay, for the 120 call, 24 to 70, it's a widespread, where 32 to 42, it's not a widespread. Okay, so yeah, so in other words, theoretically you may get 47, but in the real world, I guess it's going to be a tough one. Okay, I guess it's going to be a tough one. Okay, so I'm not happy to see this at all. I'm not happy to see this, and I'm about to conclude that we're not going to be able to tweak the trade easily. Let me try, just out of curiosity, what if I do the 125? Is it going to be that bad when it comes to liquidity? 6 and 75 is worse. So again, yeah, above the 115 strike, it seems that we are losing a lot of liquidity, and then I cannot do too much. So when are we going to gain liquidity? Well, if First Solar goes higher, First Solar is currently trading at 94.76. So if First Solar goes higher, we're gonna get closer to 120, and then that 120 call will probably show a bid-ask spread, which is gonna be more reasonable than what we see in the screen. On the screen is the 125, but we had a similar problem with the 120, right? So you would see something better as the stock rallies. So in other words, we are in the same position that we were a week, 2 weeks ago with First Solar, which is we are in a trade, is the right trade. The trade has a risk of $489, and that's what it is. We are now playing patience. We are waiting for the stock to go. And if it goes, great. And if it doesn't go, then we just need to continue and remain patient. And that's it. Okay. So it's not like we can do much more magic than that, because with that slippage, I could simulate the trade with a midpoint, but we're not likely going to get that. Okay. Cool. Okay. So when it comes to reviewing the trades, the conclusion is nothing to be done with Intel, nothing to be done with the First Solar. First Solar, for a moment, I thought maybe we can do a tweak, but not the right time to tweak it yet, and therefore we leave it alone, and we are now getting into trading mode, looking to find new trades. So I'm going to have a sip of water. Please go ahead, give me some confirmation all is good. If there are any questions, this is the time, because we are now beginning with new trades. Okay, So, so anyway, I'm back to the matrix, okay? And to be honest, I'm just gonna rerun exactly the same scan I was using the last time we met. Maca, the red UFO on First Solar looks threatening. Maybe we should close it. You mean that red UFO here? Okay, but that red UFO starts at 97. Okay, and if the price gets to the red UFO, okay, I know it looks threatening. Okay, but let's not be intimidated because if price rallies to 97, then the climate is going to be up, and in an up climate, buy orders tend to be added, sell orders tend to be cancelled. Okay, so we are focusing on the target using the purple area. Okay, that's the target we are shooting for, and yeah, so that's what we're doing. Good, good observation. Okay, good observation. But also, because we're using additional tools that we didn't use before, so I need to point at the importance of those purple areas. Okay, those speed bumps. Anyway, so what are we looking for? So we are looking for a top negative CIV spread. So we are looking for the put implied volatility to be greater than the call implied volatility. Hey, Joanne, good to see you. Rules, no emotion. Exactly, exactly. That's very well said. And of course, this is why it's also so important we do those sessions because, when we look at the markets by ourselves and we are at home and we are isolated in the sense that at that time is you and your computer. Of course, many thoughts will arise and temptations, right? And it doesn't matter how experienced you are. It happens all the time. It happens to me. I've been trading for years, and sometimes it's like, should I close it and that's it, right? And when you find yourself saying that, really, that's a little bit of some sort of a form of a fear that is triggering somewhere in your subconscious mind that is trying to convince you to close it, right? But again, we are running a portfolio, multiple trades in parallel, and if we are concerned about First Solar, we're gonna find a hedge now. That's the goal. Okay. Yeah, absolutely. So anyway, so we are looking for negative CIV spread. Everybody with me when it comes to what that means. If you don't remember what is the negative CIV spread, please let me know so I will remind you of what it is. Okay. Then I am also looking at implied volatility mean to be less than 20 percentile. So in other words, we are looking for options to be very cheap. Okay, because in order to be directional, the best thing we can do is to be a buyer of options. Okay, so we get a positive delta and gamma, well in this case negative delta but positive gamma. So we really capitalize on the moves. So we want the options to be cheap. Okay, and if we don't find them cheap, then we'll find alternatives to make the trade. But we like to start with cheap options. Okay, so yeah, so it seems that you guys remember what is the negative CIV spread. Okay, if you don't remember anything, please ask me. I'm more than happy to repeat it. Then we are looking for stocks that are $34 or above. And notice how I have selected group rotation, strong, down. Apart from that, I have my scan list, which I need to import. The penny increment options list. Also, I'm more than happy to email you that list if you need it, guys. So just ask for it. So when I rescan based on that, we got two stocks. When it comes to Elliott Wave and Strength, I got nothing. And when it comes to earnings, I'm looking for stocks with earnings at least 50 days away from now, so we don't run into any issue with earnings happening too soon, and we cannot reach a target because of that. Okay. And then the other thing that I have here is when it comes to auto climate, I have the daily climate to be confirmed to be down and to be sensible. So with all of this, I ended up with ADM and ExxonMobil, and we're going to be looking at those two companies and see if we find a valid setup for us to do the trade. Okay, so with ADM, we are looking at the climate here. It's 2 out of 7. So indeed, if this market continues falling, it could certainly continue intensively. That's great. Implied volatility, as you can see, is quite low. I mean, we know that already. Maca, I think it was the calls and the puts combined. Yes. So what the negative CIV spread means is you look at, let me show you that. Edit study. let me show you like that. Here we go. So I'm just disabling the average, okay, for implied volatility of the calls and implied volatility of the puts, okay. I can also plot implied volatility for the mean, which is the midpoint between the calls and the puts, which that is the typical one that you see in most trading platforms. But if you look at calls and puts separately, and you click OK, okay, so you can see that today, okay, the puts have an implied volatility of 25, where the calls have an implied volatility of 23. So in other words, today there is more buying than puts than buying of calls, or there is more selling of calls than selling of puts. And both selling calls and buying puts, okay, it's a bearish thing to be done. And this is what's happening in the options markets, because if that was not happening in the options markets, then the implied volatility for the puts would not be greater than the calls. Okay. So in other words, from behind the scenes, there is a bearish sentiment that is building up, okay, which is building up in the options arena. And that may not fully reflect on the candles yet, even though we can see, pretty significant move to the downside today. But again, it will tend, again, who trades options? Professionals in most of the cases. So normally, if they are betting seriously in the options arena that the market is going to fall by either buying puts or selling calls, so typically then you would see continuation of that on the candlesticks in the following days. My favorite way on how to assess that is to actually look at the 3-day average of implied volatility calls and implied volatility puts, which if I plot the average, actually the calls show 28 and the puts show 24. So it looks like as an average, the calls are winning. Okay, it looks like as an average, the calls are winning, which is indeed not ideal for what I'm looking to do, which is to see the stock fall. Again, if I had to take the trade, I would, because I'm looking for a hedging opportunity. So then, I'll get whatever is the best among whatever I find to hedge my portfolio. And indeed, today, the puts are winning, okay? Even though it would be better that it's winning overall in the last 3 days as an average, right? So if I was to build a new position, which is not a position for a hedge, I would demand the gray value, which is the puts, to be above the blue value, which is the calls. But because I'm looking for a hedge, I'm going to be okay, even though overall in the last 3 days, the calls are winning. Today, the puts are winning. So I'm just going to go with it because, again, we are dealing with a stock where the climate is defined, where the stock belongs to a weak group, blah, 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 right? And again, we're looking for a hedge. So I'm not looking for the perfect trade. I'm just looking for something which is high probability enough, and I'm gonna go with it, okay? So ADM so far is looking okay for me to accept. If I was to look at the 55-minute time frame, looking at the UFOs, so we can see UFOs with performance stats of 50.96. Okay, the EMA that we find on the daily time frame is located at 59.99, which is indeed in the middle of that UFO. So, my friends, we have an entry point waiting for us right here. Okay. Now, so if I look at this market and I look at key turning points, okay, and I use the speed bumps. So I guess you're with me that a key turning point would be this one here. So if I project, it's telling me that this market is going all the way to 57 something. Okay, so this is a very valid target. Again, if I project from here, we're gonna get the same 57 something. There is a UFO a bit lower, okay, but it may be a bit too optimistic to shoot for that UFO down here. And therefore, I'm just going to set this 57, let's call it 57.75. I'm going to set it as my target, okay? Good. So we have an entry based on this UFO. We have a target based on the speed bump. So time to plan on a trade, okay? And then we'll talk about the timing, because two things may happen. The stock comes back here and it's time to take the trade expecting it to fall, or the stock doesn't come here, does whatever it does during the day and starts going. Well, you need to find a way to jump on board, because if that stock is going, you are missing on the profit. And most importantly, if the stock is falling, it may be the S&P is falling, and therefore your stocks you are long are falling and you are not hedged. So we're going to have two rules to get in because it's a hedge. Okay, if it was not a hedge, we would have one rule only, which is wait for the UFO. But because it's a hedge, we're going to have two rules. which is either come to the UFO and we hedge, or we're going to look at the Elliott wave turning points, okay? And an Elliott wave turning point took place here, but that's, we are late to the party here. So we're going to have to wait. And in this case, our indication is either the market does whatever it does, whatever it does, whatever it does. And at some point, we got another Elliott wave indication, and then we're going to take the trade. Or maybe there is no other Elliott wave indication. It just keeps going, going, going. And then if it surpasses that pivot low, this is going to be our indication to enter. Okay. And again, this looks a bit far, but again, this is the intraday trade because this is an 8-minute time frame. So it's not that far. Okay. It's not that far. So we're going to have to be looking at both in this case. Okay. And of course, you can have your rules set up in the platform. But it's either we get to the UFO and we get in, or we get an Elliott wave turning point and we get in, or we get a break of a pivot low and we get in. Those are the three conditions. I said two. I meant to say one condition with a UFO and the other conditions without the UFOs. Okay, that's what I meant to say. My brain works in terms of UFOs. So to me, it's all about UFOs. So that's why I said two, but it's really three, right? Anyway, so let's go for it. Okay, let's plan on the trade. And I'm just going to bring the strategy builder. We said 57.75 is the target. So ADM, let's go ahead and find out more about 57.75. The only thing I want to find out at this stage, because I want to build the trade, more precisely, I'm just going to go ahead and input the target price so I get more information about the target date. Okay, that's why I'm doing this. I mean, you could certainly, and by the way, absolutely nothing wrong with it. You could go ahead and select high losers, update, and sort these based on return on investment. And here is a bear put spread ready for you to trade by buying the 55 and selling the 60. Sorry, buying the 60 and selling the 55. Okay, and this is a trade that would profit if the market falls by 62.7% if you reach the target on the target date, and this trade is indeed valid. Okay, but again, you know me, guys, I'm a bit more perfectionist than that. And one more time, simple is good, guys. Okay, so the automation built in the platform on the strategy builder saves huge amount of time and is indeed valid. So you can just go ahead here and plan the trade, based on that. Okay, so 60 and 55, you're using October 15, done, right? But what I'm going to do is I'm going to try to be a bit more perfectionist here, to try to find myself a mini edge within the edge, okay, within the hedge. And I'm going to be using the information about the target date. That's the only thing I want to use from here, which is September 24 is the target date. And with that in mind, I'm going to load the spread builder, okay, not the strategy builder, but the spread select on ADM, change the expiration date to be October 15, okay, and use the target date to be September 24, okay. So now I got September 24 from here. I just plug it in here, okay, because again, the strategy builder is doing a fantastic estimation for time to target, okay. So that way we don't need to do anything manual. It's faster. So anyway, so we have our spread select here. We need to tell what we want to do. So of course, this tool is more manual, but like everything in life, it has pros and cons. So it's not really manual, it's semi-automated, if you wish. So we're going to type the target, which is 57.75. Okay, so we got the target 57.75. We selected the spread, it's going to be bear put spreads. We selected the expiration date October 15, the target date September 24. So we have all of these ready. Okay, and now I'm just going to maximize these all the way so we can spend a little bit of time here finding the best trade we can based on what the market has to offer. Okay, so first, minimum range here is 5, and maximum range is 10. So what does that mean? In this case, it means the distance between the option you buy and the option you sell. So going back to the chart, the current price of our stock is 59, the target is 57, so there are like $2-3 distance. So the minimum should be $2-3 distance, but because of how the strike prices are set on October expiration, it's $5 strike price increment, So then the minimum is 5. And then the maximum, I'm just going to go for, let's say, 25, something like that. Okay, something big. Okay, so I can have plenty options to analyze. And once I do that, then I'm going to go ahead and say, okay, build 99 of those spreads. So I just built so many spreads, plenty of them, which are a complete waste of time. But I don't care, because now I'm going to go ahead and filter them based on a template, which, by the way, I'm also very happy to email those templates to you guys, which is the bear put spread preferred parameters. And the moment I load the template and I click OK, so I may see fail and pass. And look at that, we got one that passes. So in this case, it's very simple, which, by the way, is the 55 and the 60. The other one, the automation selected what? The 55 and the 60. So in this case, the automated way on how to build the spread and the semi-automated way on how to build the spread return the same result. Okay, but sometimes it's not the case. Sometimes you have this option that provides you with an extra benefit. Let's put the trade in place and then I'll talk about that. Okay. So anyway, so we're gonna do this. Let me zoom in. So we're gonna be doing the bear put spread made of using October 15 expiration, where we buy the 60 put and we sell the 55 put. That's the trade that we're doing. Now, there's too many things on my screen right now. It's very cool, but very confusing at the same time. So what I'm going to do is right-click and copy that position to the clipboard. So now I can go to my positions panel, and I'm just going to paste it in here. Okay, so here is my trade, my bear put spread on ADM. Okay, this is the trade that I want to execute. Now I have it here. Now I don't get confused. I am buying +1 the 60 put that expires in October 15, and I am selling -1 the 55 put that expires in October 15. That's it. Okay, so we narrow down the whole options universe to this one trade. And now it's time to execute it. Now, if you are using Top for TradeStation, you just right-click, and here you're going to have an option which is to trade. I am not using the TradeStation version. I'm using the QC version. Okay, and therefore I cannot execute. And I do it on purpose because I want to show you the execution on TOS, because many of you are using TOS, and I want to help everyone. So I'm going to go here for trade. I'm going to type ADM. I have another sip of water. And now, of course, you have the calls on the left, the puts on the right. October 15 expiration is right here. So I'm just going to right-click on the right side, okay, to buy a vertical spread. A bear put spread is a vertical spread, so we're going to select vertical. And this is now telling me buy the 60, sell the 55. I think it's just a coincidence, but it's the right one actually. So now here is a little tip using Top that will help you to avoid mistakes when you use other platforms, which is you can float that position window or any window, okay, but you can float it. And the moment you float it, you can go back to TOS and then go back to that window I just floated. And now the beauty is that, I can go ahead and compare what I have in this window, which is buy the 60 with +1, okay, +1, the 60 put, and then I got sell the 55, and here I got -1 sell the 55. And that, floating the window like that helps you to bring Top on top of another platform, so you can double check and make sure you make no mistake. Okay, so we have this trade ready to be executed here. And now, of course, we have price rules for this trade to be executed. Okay, so it's not like I'm going to confirm and send the order now, because then if I confirm and send the order now, I'm going to get filled now. And remember, we have 3 timing rules to get into the trade. One of them is come back to the UFO. Okay, and the other one is oh, look at that. We got a new pivot point that just formed right here. Perfect. Right here. New pivot point that just formed. So if price goes below that, which is 59.43, get into the trade. Okay, get into the trade 59.43. So let's put this order in place. We're gonna have, I'm clicking here on TOS. I'm clicking on the settings wheel. Okay, this is bringing additional window for me to add order rules. So the order rules I'm going to add are based on ADM. Okay, and it's going to be either ADM, okay, goes to a price which is higher, or ADM goes to a price which is lower. Okay, so submit when at least one of the following conditions is met. ADM is above a certain price, which the certain price is the UFO 5980. Okay, so if ADM comes to 5980, get that trade in. So 5990, 5980. Okay, and or ADM goes below a certain price, which we said on the 8-minute time frame, that was the purple line, which is 5943. So 5943. And by the way, price is so close that probably what makes the most sense is just to watch it manually. And if it goes below 43, you just enter the trade and you try to negotiate the spread the best you can. Okay, that would be the best. In my case, just to make sure I'm in, I'm just gonna go with a market order, just to make sure I get executed, so we can discuss this trade in following sessions. But again, in your case, I strongly recommend you, given how close we are from that triggering condition. Okay, 49 is, we are 6 cents away, right? So given that case, I would indeed recommend you to watch it. You just place an alert maybe, and then when it surpasses the purple area, just use a limit order, shave the spread like we always do. Okay. In my case, I'm just gonna go for an automatic market order with those two conditions. If that's okay, I'll click save, confirm and send. Okay, and now my order is there, waiting to get filled. There is an activation rule. You see status waiting, so that means there is an activation rule. There is a waiting condition. Okay, so we'll see that later. If we get filled or we don't. Okay, again, we should be able to travel 6 cents in the remaining amount of trading time in the day, right? So I guess that before the session is over, we should be in this trade. But anyway, so I'm gonna get my position window back into its right place. So I'm gonna dock it. Okay, I'm gonna close it. By the way, something for you to know with top, if you open a quote window and you do whatever you do in here, you type whatever symbol, you do whatever you're doing here, you paste a trade, whatever you're doing here. If you close it and you reopen the quote window, then it's gonna be empty, because quote windows are designed to be like that. But the positions window is not like that. If you close it and you open it, whatever you had in there, still there. Okay, so just keep that in mind. Okay, that there is a different way on how the quote window and the positions window work, which is done on purpose like this. Okay, cool. Questions about ADM, my friends? Are we good with ADM? Can we now look into other type of opportunities? So just checking the chat boxes. I believe we are good. Okay, so Mario, could you please, Jose, repeat how you selected the date of October 15? I let, for the date, I let the strategy builder to tell me the date. So I allow the strategy builder to deal with the target date as well as the expiration date. That's what I did. Okay, with trades such as non-directional trades, I would be more inclined to go ahead and pick multiple dates when I did the spread select, to make sure that if there is any options contract that provides an advantage, I am aware of it. But to be directional, I just go with the flow, right? And the only thing I need to pay attention to, which I did, even though it is my bad because I didn't say. So on the daily time frame, okay, you can see here the next earnings is happening on November 4, okay, November 4. And when we look at the spread builder, we have October and then all the way December. So there is nothing in November. Okay, and because there's nothing in November, so then the best I can do is October 15, which is what the strategy builder was actually suggesting. So in this case, it was very simple, but it's actually my bad because I guess the origin of your question, Mario, is because I always line up the expiration date for directional trades with the earnings report date as close as possible to benefit from that potential rise in implied volatility, which happens more often than not. But today was just not possible. Again, my bad is that I didn't mention it, so maybe I got you confused because of that. I guess that's the reason. Hopefully now it's clear. Joe, the strategy builder calculates time to target along with theta decay. The strategy builder is doing something quite advanced. That doing it by hand would be super tedious. But just to illustrate a bit what he's doing. So first, the strategy builder is looking at implied volatilities and historic volatilities. Actually, it's looking at historic because I have it selected as historical. Okay, so it's looking at historical volatilities, which is the blue lines, if you wish, and it's looking at the various expiration dates. Okay, and then on top of that, it's basically looking at a regression line. Okay, not starting on that date, starting before, right? And with all of that, it's trying to forecast when is it that we are likely going to reach our target. Okay, well, in this case, I should have drawn it to the downside because that's a short trade, isn't it? Let me rectify that. Here we go. Okay, so so it's looking at when we may get to this target that we selected at 57.75. That was more or less here. Okay, in which date that allow us for wiggle room, right? And this together with the volatility, there is a pretty complex calculation there that is trying to look at a realistic case, a little bit in the pessimistic side, but as realistic as possible. Pessimistic in the sense that we are just giving the trade a little extra time to get to the target, and I call it pessimistic because extra time equals more time decay. So we are looking at that sweet spot with giving ourselves the time to get to the target, being a bit pessimistic on it, and based on those volatility and regression line parameters, looking at what expiration date provides the least amount of problematic time decay, and that's how the tool does it. So again, if we were to do it manually, it's quite tedious. In the end, to be honest, we could do it simpler than that, but just because we have the tools, so we just do it. It doesn't take time to do it, and that's it. But you could do it a bit simpler than that. And finally, in the end, most of the times you're going to be using the date, which is lining up with earnings, which is not the case today because earnings are way too far in time. But in most of the cases, that will be the case. Okay, so you don't need to make it that complicated, but at the same time, you have top, isn't it, Joe? So you can just input that in here and go with the flow. I think is the best way to approach it. Cool. Okay, so let's continue. So back to the matrix. Okay, so look, we found a trade for us to hedge. Did we break that line? Not yet. Okay, so this is now going to be the teaser, and hopefully we got 8 minutes to go. Come on, market. We just need you to drop by 13 cents. Do that for us. That would be nice. I mean, I would certainly like to show you the trade in the account before we go. That's something that is more educational, and I would like to do that. But again, the market is the boss. So in the meantime, let's go ahead and find another type of trade. So let's say we get filled. So now, if we get filled, what do we have in our account now? Well, in our account, we would have 2 positions that are long, Intel and First Solar, and 1 position ADM, which is short, which is in there for the purpose of a hedge. Okay, why? Because overall, the S&P is in a beautiful, magnificent uptrend, and we don't want to be loaded on shorts. Okay, we just want to add that short because we concluded at the beginning of the session there is risk. Okay, so we are hedging the portfolio. We are not betting on a crash. Okay, we are just hedging the portfolio. But what else? Well, the what else I would like to discuss with you now is, okay, all the trades we have are trades that are costing us theta. they are all directional, they are all debit strategies, and therefore they are all consuming time decay, and no matter what, we are losing money just because time passes. So I would like to offset that with a non-directional trade providing a credit. You're reading my mind, isn't it? It's going to be an iron condor, and with that iron condor, find a credit coming in, and with that credit coming in, so offset some of the pain I get from the directional trades, which will pay me very well on direction. But if the stock stays stagnant, then the time decay will erode those profits badly. Okay, so I want to offset that problem, and now I'm going to be looking for iron condors. We got 5 minutes, so realistically, I'm not sure we're going to have the time to put together an iron condor, but maybe we can use that time to kind of review the process of putting together an iron condor. So we do it tomorrow, first thing first. Okay, Maka, when we take a trade as a hedge, we need to adjust the position to match the trades that we are hedging, right? Yes, you are correct, and I'm not talking about this at this stage. And you are indeed very correct. Just like I didn't say how many contracts should you use in the trade, which, by the way, is not for me to say; it's for you to decide. But I didn't point at the risk. Okay, maybe I went a little bit too fast there. So let me go back to this and show you. So if we go back to look at the bull put that we selected, okay, this bull put has a risk of $147.5. That's the risk of this trade if you take the trade now. Okay, I mean, if the market falls a bit, that bull put will gain a bit more value. So instead of 147, it may be, I don't know, 160, something like that. So that would be the risk of the trade. So that's one of the indicators that will help you to know more about how many contracts of ADM you need to use to hedge your portfolio. But apart from looking at the risk of this trade by itself, the one thing which is absolutely critical for you to determine your hedge is the delta attached to the trade. So this trade has a delta of 37. What is it that we have in our portfolio? Well, in our portfolio, if you look at First Solar, that trade, actually I don't have it here. Yeah, of course, because I'm minimizing the columns so it doesn't consume too much space on the screen. Let me add delta. Here we go. Here's delta. Yeah. So I'm going to add delta. Let's push it up right there. Good, perfect. So we're going to have one more column with delta. And if you look at delta, First Solar has 50 delta, Intel has 20 delta. So we have a total delta of 72. And you know what? Since I'm doing this, even though I'm using more space on the screen, let's add theta, since I was talking about the theta of the portfolio. So probably that's a good thing to do. So theta is here. So I'm just adding theta. Let's move it next to delta. And when I do that, so you can see how I'm losing $4.30 per day on time decay, right? So if I was to add an iron condor, you would now see a positive number there, right? I mean, depending on the amount of contrast and so on. But you would see potentially a positive number, meaning that now you are not losing money on time decay while you're exposed directionally as well. That would be the goal, right? Now, going back to the delta, which is your question, Maka, I just diverted to theta for a moment. So coming back to your delta question, so how much delta you want to hedge your 72 delta, okay? And of course, someone say, I need 72, so now I'm going to be fully hedged. Well, yeah, but if you are fully hedged, you make no money, you lose no money. So it's like, being fully hedged is the same as close First Solar and Intel now, right? So if the market goes up or down, nothing happens to you because you are fully hedged. So when you are hedging, you always need to have, a specific type of bias and rules around how much hedge you need, right? And let's say you are crazy conservative, so you may decide, I want to hedge 75% of my delta. Let's say you are less conservative, you may say, I want 50% of my delta. Let's say you are even less conservative, you may say, I want 25% of my delta, okay? So I had conducted, that was a long time ago, that was years ago, guys, but I had conducted, they are in the YouTube channel, sessions on portfolio management and things like that. And, we were looking at AutoClimate as a tool that tells you how much delta you need, but not AutoClimate on the stock, AutoClimate on the S&P. So if you look at the S&P, okay, and you see that there is a very severe risk of a change of direction, so then you may want to have more hedge. If the risk is not that great, then you want to have less hedge, less delta. And again, we need to put rules around that, which we will, but it by far surpasses my intention with the session today and the amount of time left. Okay, so I won't do it today, but at least you understand my thinking, right? So let's say you have a very simple rule, which is I want half of the delta, I want 25% of the delta. Okay, so then go for it. The ADM trade that we are providing got 37 delta. So if I do minus 37 delta against 72, I will be net, let's call it positive 40. So my portfolio overall will continue making money if the market goes higher, but if there is a drop, I'm going to collect some profit with my hedge, which will alleviate the pain collected on First Solar and Intel, okay? Which is, again, the purpose of a hedge. The beauty is to play the hedge with the timing, which is, let's say the market falls for 2, 3, 4 days, and now you make a nice profit on ADM. So then you close ADM, and as the market comes back higher, you're back in business with First Solar and Intel while you collected a profit on the way down, which is already locked in your account because you closed the trade on ADM. Or, for example, when the market fell hard recently, volatility was high, we entered Intel, but how did we enter Intel? We entered Intel by giving ourselves a cushion because we were selling put spreads way below and then buying calls in exchange. So now we gained a directional exposure, but we could afford the stock to drop by a decent amount, before we really get hurt. So again, if the market falls, you can take a profit on ADM and kind of average down on more longs by using the benefit of high implied volatility and do a fancy trade, if you wish, to get back into business as the market recapitulates after a normal correction, when the climate gets red for a few days and then back to blue, right? And you just keep playing this, okay? But again, hopefully this helps you to understand kind of like the framework that I'm trying to define and design for you guys on running a portfolio with multiple trades in parallel, directional, non-directional, and everything else, which is basically what you would do as a fund manager, right? As a proper fund trader. But in any case, I do need to answer with more precision your question, Maka, with how much delta you need, etc. So we'll put rules around all of that. But hopefully this initial explanation is helping you, okay? Joe, so it's like constructing a spread, only your entire portfolio. I love what you said, Joe. It's exactly that. It's exactly that. Yeah, that's a very nice way to put it. I never thought of explaining it like that. But what you just said right there, I think is probably very useful for many of the traders in the room that are maybe a bit newer to options trading. And in the end, it's moving parts, right? It's all moving parts that you put them together to create something bigger than the minimum unit, right? And you just keep building up pieces, and you go from one options contract to option spreads, and from multiple option spreads to portfolios, and it's all building blocks, okay? Nice, very cool. Okay, so my friends, let's do this. The other day on Thursday, I missed the session because, as you know, I was not able to deliver the session. I was not well, and therefore, what I'm going to do today is the same thing I did last Wednesday, which is I want to say bye to the ones of you that are watching us on the public streams, because we're going to have a little short private conversation to talk about the pioneers, okay, the pioneer group. And tell you a bit more about how you guys can get top with a good advantage as a pioneer, which I wanted to explain that last Thursday, but I could not. I did last Wednesday, but some of you missed the session. So